Losing trades are painful. Everyone knows that feeling. The red numbers staring back at you from your screen. The regret that settles in your chest. The second guessing that keeps you up at night, replaying every decision, wondering where you went wrong. It's visceral, immediate, and impossible to ignore. But winning trades? They can be dangerous, because not every win makes you better. In fact, some wins do the exact opposite. They quietly teach the wrong lesson, rewarding behaviors that should never be repeated. They build false confidence on a foundation of luck disguised as skill. They create patterns in your brain that feel like progress, but are actually setting you up for catastrophic failure down the line. And most traders never notice it happening. They see the profit, feel the rush of dopamine, and assume they're on the right track. The green number becomes validation. The win becomes proof. But behind that seemingly positive outcome, something more insidious is taking root in your trading psychology. Bad habits are being reinforced with every undeserved win. Poor decisions are being validated by random market movements. Discipline is slowly eroding while you celebrate results that had nothing to do with skill. The damage won't show up until it's too late. It accumulates silently, invisibly, building up in the background while you're busy patting yourself on the back. You don't see your position sizes creeping up. You don't notice your entries getting sloppier. You don't realize your risk management is falling apart because you're winning, and winning feels like everything is going right. The truth is, not all wins are created equal. Some wins come from executing your edge perfectly, managing risk appropriately, and following your system with discipline. Those wins build consistent profitability over time. They're the foundation of a sustainable trading career. But other wins are accidents, lucky breaks, random market movements that happen to go your way despite you doing everything wrong. And those wins are ticking time bombs, quietly programming your brain to repeat the exact behaviors that will eventually destroy your account. If you don't learn to tell the difference between a good win and a dangerous win, those profitable disasters will cost you far more than any losing trade ever could. Because at least a loss teaches you something. A bad win just lies to you and makes you believe the lie. A win feels like proof. Undeniable, concrete, irrefutable proof. Proof that your analysis was correct and your reading of the market was accurate. Proof that your timing was sharp and your execution was on point. Proof that your instincts are developing and your intuition is getting better. Proof that all those hours staring at charts, all that study, all that practice is finally paying off. Proof that you're not just gambling, you're actually getting better at this incredibly difficult game. The brain doesn't question success. Why would it? Success feels amazing. It releases dopamine, one of the most powerful reward chemicals in your nervous system. It reinforces neural pathways, literally rewiring your brain to repeat whatever behavior led to that positive outcome. It creates a deep sense of competence and capability, making you feel like you're finally figuring this out, like you're finally becoming the trader you knew you could be. The emotional reward is immediate and powerful and completely overwhelming to rational analysis. When you're feeling good, when you're celebrating, when you're basking in the glow of a winning trade, your brain is not in analytical mode. It's in reward mode. And in that celebration, learning stops. Think about it honestly. When you win, do you really sit down and dissect what happened with the same intensity you apply to losing trades? Do you question whether you got lucky or whether your edge actually played out? Do you analyze whether the market moved your way because of the reasons you identified, or just because it happened to move that direction for completely unrelated factors? Do you examine your execution to see if you followed every rule, or do you just look at the outcome and feel satisfied? Most traders don't do any of that deep analysis after wins. They take the profit, feel validated, and move forward with increased confidence. The brain files that entire experience under things that work without examining any of the details that actually matter. It doesn't care if you entered too early or too late. It doesn't care if you risked too much or violated your position sizing rules. It doesn't care if you moved your stop loss or held past your exit signal. If the outcome was positive, the behavior gets reinforced, period. This is exactly how winning becomes dangerous. Not because profit itself is bad, but because uncritical success teaches you to trust outcomes more than process, to value results more than discipline, to believe in luck more than systems. After a few wins, something subtle changes inside you. It's not dramatic or obvious. You don't wake up one morning thinking you're invincible or that you've conquered the markets. The shift is gradual, almost imperceptible at first, creeping into your psychology one small decision at a time. But its effects on your trading are profound and potentially devastating. Rules start to feel optional. That stop loss you always set religiously? Maybe you can skip it this time, just this once, because the setup looks so clean. The position sizing formula you committed to following no matter what. Perhaps you can bend it just a little, increase your risk just slightly, because you've been on a hot streak and you know what you're doing now. After all, you've been winning consistently. The rules were training wheels, and maybe you've progressed beyond needing them quite so strictly. Risk feels flexible instead of fixed. What used to seem reckless and dangerous now feels calculated and justified. Doubling your position size doesn't trigger alarm bells anymore. It feels like capitalizing on your improved skill, like maximizing your edge now that you've found your rhythm. You start thinking, I can handle more risk now because I'm trading better. My win rate is up. My confidence is up. I can afford to be more aggressive. Patience feels unnecessary and even counterproductive. Why wait for the absolute perfect setup when you've been winning on pretty good ones? Why sit on your hands for hours or days when you could be making money right now? The discipline that once felt essential to your success now feels like it's holding you back, like it's preventing you from capitalizing on opportunities that your improved instincts are identifying. And confidence quietly, insidiously, turns into permission. Permission to break your own rules because you've earned it. Permission to trust your gut over your systematic plan because your gut has been right lately. Permission to believe that this time is different, that you've reached a level where the basic fundamentals don't fully apply to you anymore, where you can operate with more freedom because you've proven yourself. This is the precise moment when traders lose their edge without having any idea it's happening. They think they're evolving into more sophisticated traders. They believe they're progressing beyond rigid rules into intuitive mastery. In reality, they're devolving back into the undisciplined gambling that doomed them before. And they won't realize it until the market humbles them again, often catastrophically. Imagine two traders who both just closed winning trades on the exact same market move. Same asset, same time frame, same direction, same approximate profit. On the surface, looking at their account statements, they look completely identical. Both made money. Both called the direction correctly. Both executed and exited successfully. But watch closely what happens in the minutes and hours after they close those trades, because this is where their futures diverge completely. The first trader closes his trading platform, leans back in his chair, and smiles broadly. He feels fantastic. He earned this win. He saw something in the market that others missed, and he was right. The win validates everything he believed about that particular setup, about his developing intuition, about his growing skill as a trader. He doesn't open his trading journal. He doesn't review the execution against his trading plan. Why would he? The trade worked. The market proved him right. His analysis was correct, and the profit in his account is objective proof of that. He remembers how it felt, that exact moment when price started moving in his direction and he knew, just absolutely knew, that he had called it correctly. That feeling of being right is what he takes away from this trade. The second trader also closes the trade with profit, but she immediately recognizes that her work isn't finished. She opens her detailed trading journal and starts documenting everything while it's still fresh. She records the entry price, the exit price, the position size, the risk-reward ratio, and the market conditions that existed at the time. She reviews her execution against her written trading plan, line by line, checking every decision. She asks herself uncomfortable questions. Did I follow every single one of my rules, or did I deviate somewhere? Was my position sizing exactly what my system called for? What could have gone wrong with this trade? Did I manage risk properly according to my plan, or did I just get lucky that nothing went wrong? She analyzes whether her specific edge actually played out the way she expected, or whether she just happened to be directionally correct for reasons unrelated to her thesis. She actively looks for mistakes, even in victory, even when the outcome was positive. She knows that one winning data point means absolutely nothing in isolation. What actually matters is whether this win is genuinely repeatable, whether it's part of a systematic edge with positive expectancy, or just random noise that happened to work in her favor this time. Same exact outcome, completely different futures ahead. Here's the neuroscience behind why bad wins are so incredibly dangerous to your long-term success. The human brain remembers reward, not process. It's a fundamental survival mechanism that served our ancestors extremely well for hundreds of thousands of years, helping them learn which behaviors led to food, safety, and reproduction. But in the context of modern trading, this ancient wiring works directly against us in ways that are both subtle and devastating. If a trade wins despite poor discipline, despite breaking rules, despite terrible execution, the brain still marks it as success. It doesn't distinguish between, I won because I executed my systematic plan perfectly with discipline, and I won even though I broke every rule, got lucky, and should have lost. Your conscious mind might know the difference, but your subconscious doesn't care about those details at all. All the brain's reward system registers is the dopamine hit, the positive emotional outcome, the reinforcement that whatever you did must have been correct and should be repeated. And whatever gets rewarded gets repeated automatically and unconsciously, even when it shouldn't, even when it's actively harmful to your long-term profitability. This neurological principle is called intermittent reinforcement, and it's one of the most powerful learning mechanisms in all of psychology. It's the exact same principle that makes slot machines and gambling so psychologically addictive. When you win randomly, without a clear and consistent connection between specific behavior and specific outcome, your brain becomes absolutely convinced that your actions are working, that you've found something that gives you an edge, even when objectively you haven't. So when you chase a trade out of pure FOMO, pure fear of missing out, with no plan and no edge, and it happens to work out profitably, your brain learns that FOMO trading is a valid and effective strategy. When you move your stop loss to give a losing trade more room, violating your risk management completely, and it eventually reverses in a profit, your brain learns that moving stops and giving losers more room is smart trading. When you size up aggressively, risking far more than your system allows because you're feeling confident and invincible, and the trade wins big, your brain learns that confidence-based position, sizing, and aggressive risk-taking is the path to success. None of these lessons are true. None of these behaviors have positive expected value over time. But your subconscious brain doesn't know that and can't evaluate that. It only knows that these behaviors were rewarded, and therefore they get programmed into your automatic responses, especially under stress. The truly insidious thing about bad wins, the reason they're so much more dangerous than obvious losses, is that they don't hurt immediately. There's no red flag waving in your face. There's no warning sign flashing on your screen. There's no moment where you suddenly realize something has gone terribly wrong with your trading. The damage is completely invisible to you, accumulating silently in the background of your psychology while you're busy celebrating your recent success and feeling good about your progress. Bad wins reshape behavior slowly and gradually through tiny incremental changes that feel completely insignificant in the moment. Position sizes creep up just a little bit each time. 1% of your account becomes 1.5%, then 2%, then 3%, then 5%. It happens so gradually, spread over weeks or months, that you don't even notice the shift. Each individual increase feels small and justified because you're winning more now. Entries get progressively rushed and impulsive. You used to wait patiently for confirmation, for multiple signals to align perfectly, for your complete checklist to be satisfied before pulling the trigger. But lately, you've been getting in a little bit earlier to catch a few extra points of profit. Not much, just slightly ahead of your full signal. Except now, a little earlier has become as soon as you see the first hint of your pattern. and you've completely lost the patience and selectivity that used to protect you from low-probability setups. Losses feel unacceptable instead of inevitable. You used to take losing trades completely in stride, understanding rationally that they're an unavoidable part of trading, that even the best systems lose regularly. But now, after a string of recent wins, losing feels fundamentally wrong. It feels like personal failure. It feels like something you should be able to avoid if you just try harder or focus more. So you start doing whatever it takes to avoid taking losses, moving stop losses further away, adding to losing positions to average down, holding through your planned exit signal, and hoping desperately for a reversal. Your fundamental relationship with risk changes at a deep psychological level. What used to feel dangerous and require careful consideration now feels completely normal and acceptable. What used to demand systematic analysis now gets decided in seconds based on emotion and impulse. Your risk management, once systematic and rigidly consistent, becomes entirely situational and driven by how you're feeling in the moment. And when the market shifts, when your recent winning pattern stops working, there's no defense left. There's a harsh truth that every successful trader eventually learns, usually through painful experience. Losses force reflection and deep analysis in a way that wins rarely do. And that forced reflection, that uncomfortable self-examination, is often where the real learning and genuine improvement actually happens. When you lose money, you can't simply ignore what happened and move on. The pain demands your immediate attention. The loss of capital, the emotional discomfort, the blow to your ego, all of it forces you to stop and examine what went wrong. It makes you ask difficult questions that you'd rather avoid. What specifically went wrong with this trade? Where exactly did I make my mistake? How can I avoid repeating this same error next time? Did I miss something obvious in my analysis? Was my timing off? Did I manage the trade poorly after entry? Did I follow my plan or deviate from it? A loss strips away ego and creates psychological space for honest evaluation. When you're in pain, when you're frustrated, when you're disappointed with yourself, you can't hide behind rationalizations and excuses as easily. You're forced to confront your limitations directly, to acknowledge your blind spots honestly, to admit your mistakes openly. And in that uncomfortable confrontation with reality, genuine growth becomes possible. Real improvement emerges from that honest assessment of where you fell short. But a win? A win makes you assume you already have all the answers you need. It feels like confirmation of what you already believed, not like a question that needs investigation. Why would you question something that worked and made you money? Why would you dig deeper into something that was successful? Why would you look for problems when the outcome was positive? The emotional state after a winning trade is satisfaction, contentment, validation. It's not curiosity, not skepticism, not the desire to examine and improve. That's why growth so often follows pain rather than success. Pain forces you to change your approach because what you're doing clearly isn't working. Success allows you to stay comfortable exactly where you are because everything seems fine. Pain disrupts complacency. Success reinforces it. The best traders in the world understand this psychological dynamic and actively work against it. They create systematic processes that force reflection and analysis even after winning trades. They journal every single trade, profitable or not. They review their execution with the exact same critical eye regardless of outcome. They understand at a deep level that a loss with good process and discipline is genuinely more valuable than a win with bad process and luck. Let's completely redefine what actually makes a trade good versus bad, because this is the fundamental confusion where most traders get everything wrong from the very beginning of their trading journey. A good trade isn't one that wins and makes you money. A good trade is one that follows your rules with complete discipline. One that executes your systematic edge with precision and consistency. One that manages risk appropriately according to your predefined plan. One that you can repeat thousands of times over years and expect your statistical edge to play out over the long run, generating consistent profitability through proper execution regardless of individual outcomes. You can execute perfectly, do everything exactly right, follow every single rule, and still lose money. The setup was completely valid according to your system. Your entry was precise and well-timed. Your risk management was appropriate and followed your rules exactly. Your exit followed your plan without deviation, and you still lost money because the market moved against you. That's a genuinely good trade, even though you lost. Because over time, over hundreds or thousands of trades executed exactly like that will make you consistently profitable. You can also break every single rule in your playbook and still win. You chase the entry impulsively with no plan. You oversized the position massively, risking far more than appropriate. You ignored your stop loss when it was hit. You held past your planned exit signal, hoping for more profit. And somehow, despite all of that terrible execution, you still made money because the market happened to move strongly in your direction. That's an absolutely terrible trade, even though you won. Because over time, trades like that will eventually destroy your account completely, even if they work occasionally. Only one of those approaches builds consistency. Only one of those is genuinely repeatable over time. Only one of those is actually under your complete control. The outcome of any single trade is heavily influenced by randomness and factors completely outside your control. The market might gap in your direction overnight for reasons unrelated to your analysis. News might break that validates your position. A large institutional order might push price exactly where you need it to go. None of that is skill on your part. That's just luck and randomness. But process? Process is entirely under your control every single time. You can choose to follow your rules consistently. You can choose to size positions appropriately. You can choose to manage risk systematically. That's the only part of trading you actually control. So judge yourself exclusively by what you control. Winning feels good. We all desperately want that feeling, that validation, that rush of dopamine, that powerful moment when the market proves you right and money flows into your account. It's why most of us started trading in the first place. It's the dream, the goal, the entire point. But discipline lasts longer than any winning streak. Discipline survives the good times and the bad times. Discipline works effectively in bull markets and bear markets. Discipline protects you and limits damage when you're wrong. Discipline compounds your gains when you're right. Discipline is what separates traders who survive for decades from traders who blow up their accounts repeatedly. The traders who make it long-term, who build genuine wealth through markets, who compound their capital year after year, aren't necessarily the ones who win the most in the short term. They're not the ones posting screenshot after screenshot of huge daily gains. They're the ones who maintain their systematic process when it would be much easier and more emotionally satisfying to abandon it. They're the ones who celebrate discipline and proper execution as much as profit. They're the ones who understand at a deep level that consistency beats brilliance every single time, that boring and systematic beats exciting and random. So judge your trades by behavior and process, not by outcome and profit. Review your winning trades as critically and thoroughly as your losing trades. Build your confidence on process and execution, not on results and account balance. Trust your systematic approach, even when it feels uncomfortable, even when it's frustrating, even when you think you see better opportunities outside your rules. Because the market doesn't reward confidence in the long run. The market doesn't reward intuition or gut feeling. The market doesn't even reward being directionally correct on individual trades. The market rewards consistency. Only consistency. Nothing else survives over time. And consistency only comes from one place, one source, one foundation. The discipline to do the right thing, to follow your systematic process, to execute your edge properly, even when the wrong thing might work this time. Even when breaking your rules might be more profitable today. Even when everyone else is making money doing things you know are unsustainable. That's the real edge in trading. Not finding the perfect indicator, not discovering some secret pattern, not developing supernatural intuition. Just the discipline to do what you know works every single time, regardless of how you feel. Mind over market.